Good morning, everyone, and I hope you enjoyed yesterday's sessions. Thanks to all of you who submitted your questions via the chat function, and we look forward to fielding even more of those during today's interesting sessions. For those of you that missed yesterday's conference, don't worry, as we will be sending out a link with all the recorded sessions attached. First up today is Jarrod Cahn. Jarrod joined Credo in 2001 and is the Senior Portfolio Manager for all of our equity solutions. They include our Best Ideas portfolio, our Dividend Growth portfolio, as well as the Credo Global Equity Fund, which recently surpassed its 3-year anniversary. More on that from Jarrod himself. Jarrod is a lawyer by qualification, has over 25 years of market experience, and when he's not scouring the market for equity ideas, you'll find him on the tennis court, ski slopes, or the golf course. He truly is an all-rounder. When I asked Jarrod for a one-liner of how I should introduce his presentation today, he came back with a small essay, which in the interest of time and stealing his thunder, I won't be reading out. But in short, and forgive me, Jarrod, if I've not summarized this correctly, his presentation will focus on what happened to the market this year, how it happened, what was the reaction to what happened, and is there any value left in the market? Ultimately, Jarrod is going to explain Credo's thinking behind building a diverse equity portfolio in a very tricky market condition. Jarrod, you're on the tee. Over to you.
Thank you very much for those generous words, Alan. And welcome to all of you today to this virtual inaugural Credo Global Conference. So for the next 30 minutes or so, grab yourself a coffee, sit down, relax, and hopefully enjoy while I talk through a few very interesting facts that have taken place in the global equity markets since the pandemic began. So if you cast your mind back to January of this year, and I guess it seems like a lifetime away, the market was really preoccupied with two things. One is the S&P index was reaching close to all-time highs and market valuations were looking pretty stretched. And the second thing was a bit of tension between Iran and the US, and even talk about potential World War III. And little attention at that time was being paid to a mysterious virus in China that was making its way through the country. And because it was China, and because we've known that historically there were things like SARS and swine flu, no one really took it too seriously. We, however, did actually perk our minds a bit, and we had a holding called Las Vegas Sands, which we're a little bit worried about because of the potential of a shutdown in Macau, and we actually sold the stock in January. In retrospect, it was a great sale. However, to be fair, no one could have dreamt or thought that the pandemic would have moved from east to west in the manner that it did and had such ramifications on global economies and the way that we sit today in the world. And if you, again, fast forward to the beginning of March through to the middle and actually end of March, the precipitous fall that we saw in global equity markets was staggering. The extent and speed in which it fell, roughly about 35% in a period of 4 to 6 weeks, was massive. On top of that, it was relatively indiscriminate. So it didn't matter which sectors that you were in, they were all hit. And what we really saw during that period of time was not a humanitarian crisis, it was more a credit crunch. Companies that historically could assume that they would be able to operate their businesses had to shut down. And it became a question about balance sheet strength, access to capital, short-term capital, and whether the oxygen of this capital was actually going to be cut off, and if so, for how long. And likewise, coupled with that, you saw huge volatility in the market. And if you just look at the bottom right, the VIX index, which is also known as the fear gauge, you see that volatility spiked to levels not seen since the global financial crisis of 2008. And then there were other quirks, things like commodities. And a fascinating story of WTI crude oil, the May contract, which actually ended the month in negative territory. So in other words, someone who owned that contract was paying the buyer of that contract $30 to take the oil off them. To explain that, what had actually happened was oil supply was at an all-time high at a time when demand was shut off. No one actually wanted oil because vehicles weren't being utilized, companies had shut down, and there was nowhere to store the oil. And because of this, no one wanted to take possession of the oil, and hence the fact that people had to pay people to take the oil contract away. And during this time, one really thought it was the end of the world as we know it. And to be quite honest, no one really felt fine. But what happened towards the middle of March and the end of March, again, was fascinating. Human endeavor, really, of world economic and political parties getting together to try and fight this pandemic. And what we saw was a huge response, particularly from the US, Europe, and Asia, where simultaneously the banks and the world leaders came together with unprecedented stimulus through the form of bond purchases, creating liquidity for companies, and making sure that that short-term financial credit crunch was relieved. At the same time, interest rates were cut to close to zero, and credit was given back to the markets. And then we had other concepts, ideas like the term furlough, which I can assure you 99% of people out there had never heard of. I had to look up the concept, where the government actually paid people who were staying at home for periods of 3 to 6 months. So again, a great fight back from world authorities. And what this effectively did was unleash credit, as I said before, and lead to some kind of stability in global equity markets. In fact, if you look at the performance of the S&P from the beginning of February to where we are today, in other words, if you had fallen asleep at the end of Feb and you had woken up now, you wouldn't have had known that there was actually a global crisis or coronavirus. In late August, the S&P actually hit an all-time high, and as we speak currently, it's not far off those levels. But in truth, it hasn't been that plain sailing. There have been huge winners and losers, and the disparity in returns, depending on which sectors and stocks and even countries and regions, has been devastatingly different. And what I've tried to express in this next image or graph is the dispersion of returns in various sectors. And what you'll notice, the green bars, are the sectors that really performed well are the stay-at-home type stocks, predominantly technology. And if you look at the 4 of the top 6 top performing indices, or sectors, should I say, in the S&P, they're all technology companies. You may say to me, but hold on, retailing is number 2. Retailing is effectively Amazon. Amazon makes up the bulk of that performance. And in my mind, Amazon is a technology company. The other end of the spectrum, we have some significant losers. So as I've alluded to before, the oil market has been in a disparate form, and energy companies have really suffered. Likewise, as interest rates have gone near to zero, and the worry about a recession and bank loan debts defaulting, etc., the banks and insurance sector has also fallen out of bed. And there have been other sectors, travel, leisure, entertainment. As you can imagine, any companies that are affected by social gatherings or who can't adequately distance would be affected by this. So what we've had to do, and particularly early in the pandemic, is to try and differentiate in our minds companies and sectors where there's short-term sectoral disruptions and then longer-term structural changes. So if we look at a company like Airbus or Boeing or the civil aviation sector, and you cast your mind back to February, these companies were riding top of their market. They had back orders from Asian and Middle Eastern companies ordering more and more airplanes as the reach of travel just kept growing and growing. 2 months later, these companies were in tatters. Orders were cancelled, people weren't able to fly. And what we've had is really just a complete backlog of potential bankruptcies. And as they say, structurally, this industry could take 3 to 5 years to bounce back. The flip side of that is a company like Microsoft, where the CEO comes out and says, what's happened in the last 2 months has brought forward the process which would have taken 2 years as people work from home, use enterprise systems far more, and have adapted to that type of environment. And again, the negative, automakers, where you're in a recessionary environment, people won't go out and spend money on new cars. And then you've had a few quirky binges where there's been hoarding and a run on things like toilet paper and hoarding of goods and services. And the supermarkets have had a bit of a boom time. But again, structurally, those are not long-term things. More significant are things like comments from Jack Dorsey, the CEO of Twitter, where he says to his staff, you guys can actually stay at home and work from home as long as you want. I'm sure many of you sitting today working from home are pretty much enjoying your environment. And the comments I've heard from most people is, I think this is going to be a long-term phenomena. I'm quite happy to work from home, maybe only go into the office 2-3 times a week. What does that actually mean for the commercial property market? And this could be long and devastating in terms of structural changes. There's also been this click culture where as we stay at home, more and more people are becoming comfortable with clicking, collecting online, and buying services. And that's accelerated this move to online to a level which we have never seen before. The flip side of that, again, is how does Main Street retail, cope? They already were on their knees, but this has just kind of pushed things over the edge. And there's also been an adaptation where in places like the West End where we work, where our lunchtime places like Pret and Costa Coffee are now desolate. And that's now been redirected to our high street where I'll go spend more time at our local. And clearly there's been other things, long-term, things like interest rates, which as we near more recessionary type of movements in the economy, interest rates are likely to remain low for longer, and what effect that really has on the banking and insurance sector. So we've had to rethink and refocus our attention on the companies we've owned and had to think about, the pinching points in some of the fundamentals that we apply. So going back to March, just the ability for a business to operate in the new normal was a question we never had to ask before. How effectively can a business operate by social distancing or other safety measures? Is this business model asset heavy? And this is where the technology and platform businesses has come into their own. Huge cash flows, huge balance sheets, asset light, and that's why they've taken the attention of the market. Can businesses operate in a reduced capacity environment? If you look at, for example, the airline industry, huge fixed costs, and they need a certain load level every day to break even. Having flights and only occupying 10 or 30% of the flight is just not sustainable. And then is the supply chain affected? Companies like Apple may be selling phones like hotcakes, but if there is a disconnect in terms of the supply chain, how does that affect long term? And ultimately, do the businesses benefit from stay at home? Then you have the proactiveness of the management team. Is the business model adaptable? Can you change your business model as a restaurant, as a sit at home, or should I say, a sit down business model to something where you now institute takeaways? Are your costs flexible? Taking into account not only the government subsidies and the furlough scheme, but when you take away from that and you have, to operate the business by itself, is there significant operating leverage? And how skillful is actually the management team when it comes to these things? And ultimately, it comes down to financial resilience. And what we did was we scoured all the companies we owned. And at the time when the credit crunch was really on, how long did these companies have to survive? Could they access capital markets? Could they access their banks or credit lines? And this has been a question that's been going on for the last 6 to 7 months. And ultimately, you don't want to own companies where there could be value destruction, either through the form of equity issuances, convertible debt, or even bankruptcy. And what is the ultimate cash burn? And again, these are questions that we've had to continually re-ask ourselves as we've been in and out of the lockdown scenario. So again, as I mentioned before, there are a number of stocks that have been clear beneficiaries of the stay-at-home environment. And here I just highlight 4. Zoom, which is a video conferencing business, company that probably, again, no one had heard of before the pandemic, has just enjoyed incredible run, up multiple times. Peloton, another company, while the gyms were closed, people still concentrated on exercise. And they, again, have captured the imagination in this kind of virtual world of exercise. Ocado, again, a great technology company in the UK that's transformed the way we click and collect and how we deliver through the supermarket chain, has also had a fantastic run. And then PayPal, as people move towards the internet and away from cashless environment, PayPal has again been a huge beneficiary. And these stocks, although they don't necessarily form any part of the S&P, just show how well you could have done if you owned them. But again, you look at the valuation of these companies, it's relatively uncomfortable, and it's really been only growth investors and momentum investors that have taken advantage of this performance. The S&P, as I've said to you before, has kind of just bumbled along, and quite amazingly actually ended in a relatively safe and flat environment. But there's another phenomena that's taken place that maybe skews the performance of the market somewhat. And this is the big tech companies versus the global equity market. And here I mention the 5 biggies: Apple, Amazon, Facebook, Alphabet, and Microsoft. The performance again of these stocks has been staggering. Amazon and Apple in particular, both up, in excess of 80-odd%. And the amount of weight that they actually carry in the index is maybe something that people fail to understand. Effectively, these companies can contribute anywhere between 25 and 30% of the weighting move in the S&P. In other words, if you had to remove their performance from the index, you would see a significant drop in the S&P. To put it in a different type of chart, you can see that these 5 companies, in terms of market capitalization, represent the same value as 389 of the smallest companies within the S&P. So the movement of these 5 stocks is just the same, if not equal, to those 389 companies. And therefore, the fact that they've been on a huge run recently and they've moved themselves up in a very narrow band is both great if you've owned them, but it becomes slightly problematic from a number of points of view. One is valuations of these companies start to look stretched. And 2, from a diversification point of view, do you actually want to only be in technology stocks? And that brings me on to the next issue, valuation. So we are intrinsically value investors at Credo, and what we try and do is buy stocks that are quality businesses, but again, are reasonably valued. So let's just have a look at Apple. And what we have here is the PE ratio of Apple over the last 5 years. Now, quite surprisingly, Apple actually used to trade at a discount to the S&P for most of that period of time. I think the industry and investors saw it as maybe a hardware company with a one-trick type pony asset being the iPhone, which still represents about 70% of their revenue, and with no real differentiating factor. However, something's changed quite dramatically in the last 12 months. And around about September 2019, for reasons I can't quite explain, the stock re-rated. And from trading at a discount to the S&P, it started now trading at a premium. And that premium, particularly in the last 6 months, has extended to levels that we've never seen before. Now that's all good and well. And one may say, well, Apple's doing well and that they can grow into their earnings. But if you analyze the actual earnings growth per share and even their revenue numbers, it's been fairly pedestrian. So all they've done over the last few years is actually just buy back stock, financially engineer their EPS. And what you've seen in terms of the share price movement is a complete re-rating of the stock from a multiple point of view. And that leaves me slightly concerned, because should there be rotation, or should the stock be out of vogue because of lack of innovation, or whatever the case may be, you could see quite a hard sell on the stock on the downside. If you juxtaposition that to Facebook, which again is a great technology company that's also done very well over the last year, it's slightly different. Here, Facebook historically used to always trade at a premium to the S&P, but there were various points in time where the stock actually gave you an opportunity to buy in. And that's when there were various scandals, the Cambridge Analytica scandal, and then you had a data scandal again. And with that, as I say, you've had opportunities to buy the stock. And as the performance of Facebook hasn't been quite as stellar as Apple, what you have now is a stock that trades on sub 25 times multiple, when the S&P trades on about 22 times. And that's more palatable given that you have slightly more downside protection. So this is a stock that we would want to own in the future. And I do believe there will be points in the future albeit when there's noise about maybe breakup of technology companies, or even just corporate governance issues within Facebook, where you will get an opportunity to add to the stock. And this brings me onto the next theme in this story, which is the relationship between value and growth. As you're probably aware, at Credo, we consider ourselves value investors. Not deep value, we're not cigar butt investors, but we like to buy quality businesses at reasonable valuations. And if you look at the relationship of value versus growth over the last 90 years, you'll see quite an interesting story. Certainly from 1940 until 2000, value excessively outperformed growth. Then we had the dot-com boom, which is depicted by the red sharp dagger movement in 1999 to 2002, where the dot-com growth stocks massively outperformed and then crashed. And then we had again outperformance by value over growth until around about 2013. And again, it's been well documented how value has underperformed growth for the last 7 years. But most interestingly, if you fast forward to the end of that graph, the last 2 to 3 years, the extent to which value has underperformed growth has been extensive. So much so that if you look where we are today, the underperformance is even greater than in the dot-com boom. So we're at a level where we have huge divergence in performance. Now, I'm not sitting here today and saying this is the end of growth, but what I would say is that from a style point of view, I'd be far more comfortable moving slightly more into value stocks than growth stocks, given the differentiation in performance and also the valuation difference in the two different types of stocks. So going forward, the question is, where do you position your clients' portfolios? And although we don't look at short-term noise, we do obviously consider short-term macro events that could affect some of the positions in our portfolio. So the big elephant in the room is clearly coronavirus. Will there be a vaccine? If so, when will it be readily available? And if it is readily available, will it be open to everybody? If not, do we have to wait for herd immunity? What actually is herd immunity? What's the percentage? How many people does it take to get to herd immunity? Will, in the interim, there be further shutdowns? And if so, where? And what effect will all of this have on global economic growth? And then we have another big issue coming up in the next few weeks, and that's the US elections. Will Joe Biden win the elections? If he wins the elections, what does that actually mean? Again, it's well documented in terms of corporate taxation, but the flip side of that is that there could be a huge stimulus package where there's a redirection of that taxation to other parts of the domestic economy. Where will there be changes to the healthcare system and funding, and what effect will that have on some of the stocks that we own? And then again, you could have a more consistent foreign policy where the relationship between China and Russia and the like could actually improve, which could be beneficial for some of the Chinese ADRs. And then, you just never know. Could Trump pull it out at the 11th hour like he's done historically? And if he does that mean that he becomes more aggressive in his stance, knowing that it's got another 4 years, or does he just fade away? Ultimately, we don't set up our portfolios for binary outcomes, but we do intrinsically look at the effects of all of this on our portfolio and keep rejigging and refreshing some of these theses. And then lastly, there's Brexit. And to be quite honest, who knows? I think in the UK, we are suffering from Brexit fatigue. I think the market posture right now is a lot of it's already baked in. A no deal or close to very light deal may happen. And if so, the effect, I think, has already been felt to a large degree on the market. But to put it into perspective, the UK market is such a small part of the MSCI. It really doesn't form a massive part of people's mindset. Clearly, we do have UK portfolios, UK focusing, and we need to look at it. But ultimately, we have scanned a lot of these companies, and a lot of it is baked into the price already. So the way we think of portfolios going forward is to try and put into buckets. What we would consider is the core bucket on the left-hand quadrant. These are companies that are resilient, with resilient business models and strong balance sheets, stable compounding returns, and either have had a positive or net neutral impact from COVID. And then you have what I'd consider probably the more interesting bucket, the impacted companies that are still great quality franchises that are temporarily impaired because of COVID and quarantine measures. And then lastly, which is slightly less relevant today, but was certainly more relevant in March and April, was what we considered the ICU bucket, the spicy tail, companies where there were relatively binary outcomes depending on, as I said, oxygen, the access to capital, and how that could impact their businesses going forward. But most of those companies have passed through now, and they've actually had the access, they've had the rights issues, they've managed to get further loans, and they've survived. So there's less of that type of binary outcome in our portfolios. But really, if you concentrate on the portfolio, you need to be somewhere between the core and the impact but quality bucket. And depending on your view on whether there'll be a vaccine, whether there's going to be continued shutdowns, whether there's going to be a rotation trade, will depend on how you shift the balance between the core to what I'd say the middle quadrant of quality. And just to put a little bit of color on those names, on the core, you have companies in the technology space that again are relatively reasonably valued. So Microsoft, Facebook, Alibaba would fit into that quadrant. And then other companies that have also benefited. IG Group, which is a UK financial spread betting business, which has really benefited from a huge amount of volatility in the markets and the fact that people have stayed at home and have used it as a source in a way of entertainment. And then Verizon and Progressive, which I'll get onto slightly later. But again, the slightly more interesting bucket is the impacted but quality. So franchises that are either one or two in their space. So companies like Madison Square Gardens or Walt Disney or Crown Resorts that, depend on things like crowds, like the lack of social distancing, and just events. And these companies have really had to reinvent themselves or shut down and just bite the bullet in the short term. Are these permanently impaired businesses? Probably not. But you have to be patient and you have to take a view. And I think this is an opportunity where if you can close your eyes for however long, 12 to 18 months, you do get the opportunity to buy some really great businesses that are unloved at the moment. And then again, moving to the financial sector, companies like Arch or Wells Fargo, again, really out of favor, but screening relatively cheaply. And in the ICU bucket, I've put a company like Meggitt. Meggitt, if you, again, fast forward to February, had traded an all-time high. And since the civil aerospace industry has fallen off a cliff, Meggitt has had its own problems. And they've managed to maneuver and do quite well under the circumstances, but the stock has practically halved. So just moving on now, just to two examples of stocks that we believe are good value propositions that we've looked to buy over the last few months, in fact, the last 18 months. And again, just to hone in our type of philosophy in terms of how we think about companies. These aren't technology companies, they're not growth companies, they're not very sexy, but yet we've managed to do pretty well on them, particularly on the first one. So Progressive is a very boring company. In fact, you probably wouldn't have heard of it, but it's the fourth largest personal lines insurance company in the US. They do auto car insurance. And if you look at the blue line, that's their growth profile over the last decade relative to their peer group. And what they've done is that they've taken market share almost practically year on year. And their key factor or USP is the fact that they go direct to consumer. So they don't rely on the value chain, and hence they have cheaper and more keen pricing. Also, if you look at their book value per share, it stands out relative to their peer group. This is a great quality compounding business. We bought this business in February of 2020. So from a timing point of view, was not great. And also, if you look at the movement in the share price prior to that over 5 years, we actually bought the stock when it was trading relatively to a new high. Since then, there was a short-term dip and the stocks performed very well and now trades in the mid-90s. But if you scratch behind the surface, you actually see the logic and thinking behind why we bought the stock when we did. So again, if you just follow the blue line, which is Progressive's PE ratio over its history versus the S&P, what you'll notice is that, first of all, the gap between the S&P and Progressive when we bought it had moved out to levels that we hadn't seen before. In other words, from a company trading at a premium to the S&P, it actually started trading at a discount and that discount became extremely diverse. Likewise, if you look relative to its own PE, the stock used to trade on roughly a mean of 16 times, and we managed to pick the stock up on somewhere just above 14 times. And we've been relatively lucky because, as you know, when people stay at home during coronavirus and lockdown, they can't drive their cars. And if you don't have your car on the road, it means that you're less likely to have a car accident. So although they've been picking up premiums every month, their payout ratio has been much lower. And again, just to illustrate that slightly differently, if you look at the miles driven in the US from the time of Corona to date, you'll see a huge fall off of nearly 50% during the Corona pandemic. And that's come back somewhat, but it's far off the levels that it was pre-COVID. So they have been a huge beneficiary. And one may argue that this is not a long-term thing. And to that point, they've actually returned some of their premium to customers to actually prove loyalty. But again, we think this is a relatively inexpensive company. It trades well, it had a boon, and we're quite comfortable owning it going forward. The second company is slightly more interesting, Madison Square Garden Sports Corporation. Now, this just shows you maybe a different way about how we think about companies. When we bought Madison Square Gardens, it was about the middle of 2019. And it was at a time when MSG had announced the split of its two businesses, MSG Sport and MSG Entertainment, which was due to complete in April 2020. And the view there is if you broke up the two various businesses, MSG Sport and MSG Entertainment, the sum of the parts of MSG Sports was not properly captured in the valuation of the total entity. So MSG Sports is the company that I'm going to focus on today. And effectively what it is two large sporting franchises. You have the New York Knicks, which is the premier basketball team in New York, and you have the New York Rangers, which are the premier ice hockey team. And these are top franchises. It's like the Liverpool or Manchester United of the US equivalent. And then you have MSG Entertainment, which again, I'm not going to discuss, but that's where Madison Square Garden Arena sits. So sports teams are trophy assets. And as you're probably aware, there are about 60 odd billionaires that control sporting teams and sporting leagues around the world. So examples of that would be Steve Ballmer, CEO of Microsoft, Joseph Chai, who's the co-founder of Alibaba, who recently bought the Brooklyn Nets. And I'll actually allude to that a little bit later in the presentation. And you have Stevie Cohen, SAC, infamous hedge fund manager, who again recently just closed on the New York Mets. And then Hasso Plattner, for people sitting in the Eastern Cape at Fancourt today, would know him very well, who owns the San Jose Sharks. So why do we like Madison Square Garden? So what happens is every year, around about February time, Forbes comes out with an annual valuation estimate. And what they do is they try and put a number on what they think the franchise is worth. And in February this year, the New York Knicks was valued at $4.6 billion and the New York Rangers at $1.65 billion. Now, this is relatively relevant, and you may say, well, this is just pie in the sky. But if you look at recent transactions, and again, this is why I allude to the Brooklyn Nets, is Chai just bought this company at a premium to the Forbes valuation. And likewise, the Houston Rockets in 2017 was sold at a premium to its Forbes valuation. So we do not think that this is pie in the sky and unreasonable. If again, you look at the current price of Madison Square Gardens relative to the Forbes valuation, you get an enterprise value around 6.25 billion. You take off the debt of 250 and you get to a 6 billion equity value. That equates to a share price around $250 a share. Today, the stock sits at $150 a share, which would imply an upside in a perfect world, if there was a bid at that valuation, of around 67%. Now, you can do your numbers, you can discount it, you can tell me that no bid is coming, and that's fine. But what this really does is give you an indication that the stock is not trading at a very high valuation, and that should there be any short-term noise or any type of movement in terms of shareholding movement, the stock could actually pop. But the real question is, does the COVID-19 pandemic affect the valuation of these companies? Why do billionaires actually buy sports teams? The answers are twofold, really. These are trophy assets. There are not many of them around. And what you find is urbanization takes place, and they are very scarce. But yet, there are more and more billionaires that are being produced every day, and they want to own these assets. So it is a bit of a vanity purchase. But likewise, the actual value of these companies does go up every year. And in fact, if you track Madison Square Gardens over the last decade, the NAV per se, or the value per se of the franchise, tends to tick up low single digit every year. So if you think of it almost like a property, it grows, by 8% every year without doing much. And that's really because of the scarcity value. But another very important advantage is the tax advantage. You can write off these businesses once you've purchased them as an effective assessed loss. So you can take whatever you've paid for the company and write that off over a 15-year period relative to the income that you've earned in your personal tax. And if you're a billionaire, this becomes a very tax advantageous thing to do. So does 1 year's earnings really affect the valuation of these companies? And yes, Madison Square Gardens may lose 100 million of revenue this year. They still are selling TV rights, but they're not getting any ticket take. They're getting very little merchandising and advertising to that point. But does it really matter in the big picture? And our view is when you're buying a company that's trading at such a discount to something intrinsic, something could give. And you may see the likes of Silver Lake that already owns a 10% stake, or any number of billionaires popping their head up and looking to take a pop at Madison Square Gardens. But ultimately, when you're balancing your portfolio going forward, you need to marry two things. One is the ongoing economic data and how that affects your individual equity stocks versus the elephant in the room, the COVID virus, the lockdowns, how long companies won't be able to operate properly for. And getting that balance right in terms of the rotation from the growthy momentum type stocks that have really benefited versus those slightly more unloved stocks that will come out of this stronger, better, and are trading relatively cheaply. That to me is the key to where the returns are going to be made over the next 12 to 18 months. So I just want to end off now very much like I did last year with this graphic, which you may or may not recall. And just again to remind you that at Credo, we try not to follow the herd mentality. We don't change our strategy, even at times where momentum and growth have been in vogue, and it's very difficult as value investors to sit and watch some huge moves in the market. But more importantly, it's a question about herd immunity. As we sit here this year, virtually not being able to see customers and clients like we normally do, hopefully we get to see you next year in a physical environment where we can chat and talk and have a glass of wine together. So stay safe, be well, and hope to see you soon. And I hope you enjoyed the presentation. Lastly, if you have any questions, please feel free to send them through and we'll answer them as soon as we can.
Thank you for joining us this morning. We hope you found the update with Jarrod insightful and has given you a good sense of how Credo are positioning our equity portfolios. As with all our presentations during the conference, Jarrod's session is being recorded and will be made available on our various social media platforms shortly. For those who require it, your CPD certificates will be emailed to you. We will now be having a short break before our next presentation with Ainsley Toe, which will kick off in 10 minutes. For those registered to attend, please simply click on the link provided in your registration email from Credo.